Hello and welcome, everyone. We have a very special guest with us here today, Hewitt Heiserman. He authored this book, It's Earnings That Count, and he is currently finishing his second book, The Checklist Investor. The interesting thing about today's talk is that he is going to be sharing material, which I'm told might become his third book. So you guys are the first ones to get a look at it. Mr. Heiserman is a member of the Boston Security Analyst Society and CFA Institute. He's been quoted in various publications, including the Wall Street Journal and Barron's. He has spoken to several CFA groups, as well as Fidelity Management, Franklin Templeton, and the American Association of Individual Investors. He is, interestingly, an Ironman finisher and is active in open land preservation. Lastly, and I guess more importantly, he is a recipient of the Kenyon College's Faculty Award for Distinguished Achievement. And he will be speaking to us wearing his teacher's hat. We are really glad to have you here. Ladies and gentlemen, please join me in welcoming Hewitt Heiserman.
The title of my talk is Ben Graham and the Growth Investor. And if you know anything about Ben, you know that famously he was a value investor. He wanted to buy companies that were cheap in relation to their corporate net worth. So this may seem like a paradox, but I will explain everything shortly. I want to draw your attention to a study that was done by Jeff Smart, a PhD, of venture capitalists. And these VC firms, including some here in this area, were profiled by their personality type. And then their performance in terms of which companies they were investing in. Again, these are early stage pre-revenue companies, highly speculative, maybe just a couple of people, no assets to speak of. The personality type that performed the best were the airline captains. They averaged almost an 80% IRR on their investments. The airline captain followed a disciplined, repeatable, and explainable process when they were interviewing potential candidates to finance. In other words, they were using a checklist approach. And this applies to what I'm going to talk about today. This chart here shows that for the last 30 years, just 25% of the stocks created all the stock market returns, and 75% of the stocks either broke even or they lost money. And this chart shows that 1 out of 5 is a big winner, 40% lost money, and 1 out of 5 is a big loser. So if we can tilt the odds of success in our favor, that's a tremendous advantage. So we're going to be using a checklist approach, which is kind of like a race where there's a series of hurdles. And in our approach, not every company will reach the finish line. You probably know that airline pilots use checklists, and even a company called Google uses checklists. There's a great book by Atul Gawande called The Checklist Manifesto. If you haven't read it, there's a lot of good information in there. So here's our checklist for the growth investor. We're going to go through these 5 items. We're going to spend a little more time on number 1, earnings quality, and number 5, sell. The 3 in the middle, we're going to go over a little bit faster. I want to acknowledge the luminaries that have spoken here in this series before me. I've tried to watch every presentation. I've taken notes as I've watched these other individuals speak. There's a lot of excellent content. I want to acknowledge the people that have helped me get here. My high school, the Haverford School. Haverford last year had the #1 ranked boys lacrosse team in the United States. Kenyon College has more NCAA championships than any school in the United States, with the exception of 3 California schools, USC, UCLA, and Stanford. Kenyon was named one of the most, having one of the most beautiful campuses in the world, according to Forbes. And Chuck Huggins, who was the CEO of See's Candy, was a graduate. Charlie Munger, who is the vice chairman at Berkshire Hathaway, said that See's was their first high-quality company that Berkshire bought, and that opened up the door to Coca-Cola. It enabled them. They were able to realize the value of pricing power, competitive advantage, and some of these qualitative things that they really hadn't paid attention to earlier in their partnership. And of course, I want to acknowledge John Bogle, the founder and former CEO of the Vanguard Group. Mr. Bogle wrote the foreword to my book. If he were here today, he'd say three things. Number one, no one knows nothing. That was the advice he first learned when he got into business in the early 50s. Second, most of us should have most of our money in index funds. And third, his life's motto, press on regardless. When I visited Mr. Bogle last April at the Vanguard headquarters, interestingly enough, Google's historian was on their campus that day, and he had just left Mr. Bogle's office as I was going in. After my book was published, Barron's wrote this article that I wrote and about the earnings power chart, which we're going to discuss. They also published a letter to the editor that I wrote, in which I said, now this is in December 2004, you had just gone public in August of that year. I said that it was unlikely that Google would make $14 billion of earnings by 2014. Actually, I said $10 billion. In fact, you made $14.4 billion. So congratulations. I also mentioned this because 5 years ago, I bought a company that went bankrupt. And that was the first time I'd ever bought a company that went bankrupt. The point is that these are my ideas, but it's your money. So I want you to test everything that I say today. I'm finishing a book called The Checklist Manifesto, which Miles Thompson at Columbia University Press will publish. That should be available in a year. Just to help you get the lay of the land here, there are 6 broad reasons why you might buy a company's stock. Yield, growth, company's cheap in relation to its net assets, people, special situation like a spin-off, and then other includes short selling. I'm going to address this second column from the left, growth investing. I think this is the most intuitive of the 6 approaches, or the most human. We plant a tree in our yard and we watch the tree grow, and then it has flowers or fruit. Or if we're a parent, we have kids and we watch our kids grow up. I think we can all relate to the growth approach. One of the great growth stocks of the last 25 years is Microsoft. If you or your parents were lucky or prescient enough to buy $10,000 in 1990, those shares grew to $1 million by the end of 1999. Now you can see in these blue bars here, that's earnings per share. And you can see how they keep growing over time. And that's what Wall Street loves. There are some advantages of buying a growth company. Chance to make a lot of money, which gives you more control over your life. You may even be able to go on and do something else, help other people. There's no exquisite timing required. You can buy a toeholder position today and then build that position as you get to know the company better. There's no capital gains tax, so your money compounds faster. And then there's a psychological benefit. You can, the pride of discovery, the joy of ownership, that sort of thing. But it's important to point out that growth investing is very difficult. Now, it's not as difficult as free climbing at Yosemite, or even getting a job here. Just to introduce the price-earnings ratio, Amazon's price is about $507. It's going to earn about $4.46 this year, so its price-earnings ratio is 114. If Amazon makes that same level of earnings forever, you'll wait 114 years to get your stock price purchased back. Alphabet's about 20 times earnings, the market's about 21 times earnings, and then Apple's about 10 times earnings. I introduced the PE ratio because this chart shows that on the left, these are your growth companies. These are the companies that have the highest price to earnings ratio. And the companies that we believe are going to have the most growth in front of them, we tend to bid up their price. So they have the lowest subsequent investment returns. And then the companies over on the right, these are your lowest PE stocks. And the irony is that they have the highest returns. There are three reasons, three obstacles that confront the growth investor. First of all, we buy a company that has poor earnings quality. Second, we buy a company just as its competitive advantage wanes. And third, we overpay for value that never materializes. So here's our checklist that we're going to work with today. And we're going to start with number one, earnings quality. And to do this, I want to introduce generally accepted accounting principles, or GAAP. GAAP is Robert's Rules of Order for Corporate America. When you open up an annual report or a 10K and you look at the financial statements, that's GAAP accounting. And we need GAAP accounting just like motorists need traffic lights. If we didn't have them, we'd have chaos. But net income and earnings per share, we think of them as hard numbers or fixed numbers, but that's not the case, as I learned 30 years ago when I read this landmark book, Quality of Earnings by Thornton O'Glover. He points out in this book that there are many accounting decisions that a CFO can make that influence just how much or how little money a company makes. Bill Ackman, a billionaire hedge fund manager, describes Quality of Earnings as on his short list of recommended reading. Just as an aside, after I finished my first book and I was looking for people to write an endorsement, the first person I called was Mr. O'Glover. I didn't know him. And we talked and he quickly said yes. And then I found that after that conversation, as I was asking for other endorsements for my book, when I told him that I got the green light from Mr. O'Glover, the endorsements came fast and furious. He wrote just as a side note, he wrote a op-ed piece for Barron's last fall, and he argues that Berkshire Hathaway it's time for Berkshire to deconglomerate. It's too big, and that the pieces are worth more than the sum. So this will be an interesting trend. It's a non-consensus view. This will be something to watch over the next several years. Anyway, two other books that I read which influenced my thinking. The first, Cash Flow and Security Analysis by Joshua Livnett and Ken Hackle. And they introduce what's called a free cash flow income statement. And their argument is that the GAAP income statement, which we see here in the center, it doesn't tell you how much cash is coming in and out of the company. And so a better measure is one that takes into account investment in fixed and working capital. So let's look at Alphabet's results for 2015. These results were just posted on Friday. I pulled them off your website. You made almost $75 billion. So I'm in the GAAP column right now. You made $75 billion of revenue. You had $59 billion of expenses. Your net income $16.4 billion, and earnings per share about almost $22 a share. On a free cash flow basis, we're going to expense investment in fixed capital. Well, what does that mean? That means if you're going out and you're buying rockets, for example, or other businesses, or other machinery or equipment that is above your depreciation, that is a use of cash. And depreciation is just your old capital spending that gets written off over time. So in Alphabet's case, last year you made an investment in $8.5 billion. So that's $8.5 billion of cash that's coming out of your corporate checking account that does not appear in the GAAP income statement. Another, yes?
Is that a total number, or is that the number above depreciation?
It's above depreciation. That's an excellent question, yes. What you do basically is you take capital spending, you go to the statement of cash flow, and you take capital spending plus acquisitions minus depreciation. And the reason I include acquisitions because Many companies buy other companies because that's a faster way of getting up to speed than building something de novo, where you got to hire people, you got to get, so it's just a faster way. So 8.6 billion investment in, or 8.5 billion investment in fixed capital. Working capital investment is more modest, 827 million. You have some receivables, you don't have any inventory. So in the big scheme of things, that's just a rounding error. So on a cash basis, if you will, Alphabet last year made $5.96 billion. And one thing I like to look at is I like to see what's the percentage of free cash flow earnings to GAAP earnings. And here we see that ratio is 37%. So that idea is from this book, Cash Flow and Security Analysis. I then read another book called The Quest for Value after reading about Coca-Cola. There was a cover story in Fortune magazine, 1995, 1996. And Roberto Gozzetta, who was the CEO, was lauding this EVA approach to capital allocation. And Coke at that time had a 10-year track record of creating some serious amounts of stockholder wealth. This EVA income statement is unique for its own two reasons. Now you'll notice that it does not expense investment in fixed and working capital, at least not immediately. What it does expense directly is intangibles like R&D, money that you spend on patents. These would be relevant for your business. Other businesses, it might be the cost of buying subscription lists or marketing efforts, pre-store opening costs. So I want you to compare the difference between the GAAP expense for intangibles and the EVA approach. There's about a $4 billion difference. The EVA approach actually credits you back about $4 billion worth of expenses because the mindset here is we're going to spread those intangibles over their expected useful life. So if you're investing in your people or your processes or your intellectual property today, we don't expect you to derive value from those outlays today. We think they'll occur in year 2, 3, 4, 5, 6. So we're going to try to match current sales with current expenses and future sales with future expenses. The other income statement here that's noteworthy is the interest expense or cost of capital, which is about $5.7 billion. In the EVA approach, not only is debt treated as an expense, but so is stockholders' equity, which you have a lot of. And so in the EVA approach, if you buy Alphabet stock or you buy Coca-Cola stock, Procter & Gamble stock, you have an expected return mindset. You expect to get some return on your stock. And so what the EVA approach tries to do is to capture that cost. Now, if accounting's not your thing, the good news is that's the end of the accounting for today. So I was in a quandary. When do I use the free cash flow income statement and when do I use the EVA income statement? And I built both of these alternate income statements in Excel on my computer, and I had them, and I just didn't know which way to go. And then I read a passage from one of Ben Graham's books. Now, Ben is the first great investor teacher of the modern age. He came to the United States with his family, graduated from Columbia with 3 offers to teach in 3 different departments. His father had just passed away. He needed to make some money for his mother and 2 younger sons, so he got a job on Wall Street, and he started to make a lot of money pretty quick. And then the Depression came along, and he was speculating, and Ben got wiped out. So he rejiggered his investment methodology, and he developed this margin of safety principle, which you're probably familiar with. And we all use margin of safety in our lives. If you have to be at work at, what time do you have to be at work here? Whenever. All right. If you have to be here at whenever, and you know it takes a half hour, you leave 45 minutes before just in case something happens. So that was his framework for approaching stock selection. Warren Buffett explains margin of safety this way. He says you build a bridge that can carry a 30,000-pound truck, but then you have a weight limit of 10,000 pounds. Now, Alphabet has a margin of safety. It's a redundancy. It is your data centers that you have around the world. I assume you have them. You had them as of last week. All right. So it's the same idea. It's a margin of safety. If one data center goes down, you got others that you can use. Anyway, Ben writes in The Intelligent Investor, he says there are two types: the defensive investor who wants to avoid committing ruinous mistakes, and the enterprising investor who wants to own companies that are more promising than most. So I'm thinking about this. I'm thinking, the defensive investor is kind of like a commercial banker. If it's raining, they want the umbrella that they lent you, they want it back. And they think about corporate profitability kind of like a lemonade stand, because the way that they're going to make money is if you can repay that loan. And so they're going to focus on how much cash you generate. They're not going to get rich owning your business. So their mindset is very pessimistic, hard money. And that's the way the free cash flow income statement works. And then the other personality type, I think of it as the way a venture capitalist looks at a business. Here at Alphabet, you have two funding entities, right? They're both early stage. This is according to what I read in the papers. When they sit down and they look at business opportunities, they're creating a pro forma, so they're modeling out revenue going out several years, and then they're modeling out expenses. And they're going to depreciate or spread over time intangibles and capital spending. But they're also, they want to make a return, because your stockholders want to make a return. So they're going to have a line in there for the financing that they're providing to this entity. So I want to make a proposal that the GAAP income statement is two venture capitalists for the defensive investor and is two commercial banker for the enterprising investor. And now we're going to return to Alphabet, and we're going to look at 5 years worth of your performance. Now the blue bar, that's your GAAP net income, and that's in the middle because it's kind of in between these two opposing viewpoints about what is corporate profitability. We see a progression of increase, positive progression over the last 5 years, so that's impressive. We have our defensive profits on the left, and you see that beginning in 2013, the gap between GAAP net income has widened, and that's because you're making tremendous investments in fixed capital. Now, if you had a lot of debt, if you had a history of write-offs, if your ownership culture, if I wasn't comfortable with your ownership culture, if I looked at this dichotomy, it would make me somewhat troubled. In Alphabet's case, there's nothing to suggest that these investments in the future are anything to worry about. With the enterprise income statement, we can see that there's a tighter correlation between GAAP profits and enterprising profits. So this gives me comfort that you're making pretty high returns on your earnings. Most of what I'm talking about today, these are ideas that I've collated and thought about from other investors. I guess my one little contribution to this field, such as it is this what I call the earnings power chart. And so in this approach, we're going to reject the GAAP income statement because it's like being half pregnant. We're going to focus on the relationship between defensive and enterprising profits. And as you would think, there are 4 boxes, and the best box to be is in the upper right box. That means you have defensive profits and enterprising profits. And that's where Alphabet has resided for the last 5 years. We're now going to step back 15 years to a company called Enron. Enron, in the late 1990s, was one of the best performing stocks. It was a stock to last the decade. This is of the 2000s, according to a business publication that's prominent. Its CFO, Andy Fastow, was named Best CFO, Chief Financial Officer. And yet, a lot of people were buying Enron because they thought it was a growth company. They were buying, their thesis was based on the income statement. But when we look at their earnings quality through these two alternate metrics, we see that they were in the lower left box every year. So if you were thinking of buying Enron and you ran those numbers through this model, you'd have to reject that thesis. There might have been other reasons to buy the company, but it wasn't because of their earnings quality or their earnings growth. After I finished looking at Enron, I wonder, are there either of these two alternate income statements or maybe the earnings power chart tell you in advance that something was wrong with all these other companies? All these other companies here, they all ran into financial difficulty and cost stockholders lots of money. And so I wanted to be like I wanted to see if there's something you could have known before the carnage. And what I found is that often the defensive income statement told you that that the company had poor earnings quality and you should be on high alert. And often it was the enterprising income statement. And then sometimes it was both alternate income statements, as we see with Enron. I didn't do an academic study for that, but what I did do is I would say about probably 85% of the companies that I looked at that ran into financial difficulty, one or both of these alternate income statements told you something was wrong. And you may, a case with some of these companies that go bankrupt, you may not expect that they go bankrupt, but it gives you a starting point to say, okay, what's the relationship between capital spending and depreciation? Or if working capital is a problem, why are their receivables going up, or why is their inventory going up? If their inventory is going up, maybe consumer preferences have changed, and maybe consumers are moving on to generation 5, and they no longer want generation 4, which is what that company may have to offer. So it's really a starting point for further investigation.
In the 70s, there was a ratio called Altman Z-score that
Yep.
was invented that
Yep.
Also has some correlation with what companies go bankrupt. Do you know how all these companies kind of scored on the Altman Z-score?
That's a very good ratio to use, and that's faster than building an earnings power chart, because that information is available, I think, at Old School Value, for example, which is an excellent website if you're a do-it-yourself investor. To answer your question, I did not look at these companies in terms of their Altman score, because I was trying to learn.
I would guess like Enron probably had a high Altman Z-score because
Yep.
they were hiding the debt. So maybe it's not as predictive as maybe this, because if the company is hiding debt, then the Z-score is going to come out fine.
Right. Although the Z-score may have picked up, there's another ratio, the accrual ratio, and the accrual ratio may have picked up some of the problems. But the reason why I like seeing all the three income statements side by side, because you can just go through each expense and you look for something that's out of the ordinary. And then you can take that information, you can take like their investment rate and fixed capital, and you can compare it to the industry average. So it's really like a jumping off point to do further research if you see something that's wrong. Okay, enough of failure. Let's look at success. Here's Microsoft during the 1990s. Remember, this company turned a hypothetical $10,000 into $1 million. This is what we call, to use Peter Lynch's description, a 100-bagger. What we see here, I see three things. Number one, the company is in the upper right box, so it has high quality earnings. Number two, it's moving every year in an upper right direction. So I call this an earnings power staircase. This is a sign of profitable growth. Not only is the company getting bigger, but it's getting better. And then third, a couple of these years, look at the rate of change from one year. Look at 97 to 98, and then 98 to 99. It's just explosive growth. And this is what Wall Street loves. There's a great book by Chris Mayer called 100 Baggers. If you want to learn more about these kinds of companies, I highly recommend this book. It came out last fall. We're now going to look at other companies that had earnings power staircase-like patterns. And we're just going to go through this kind of fast. But I just want you to appreciate that positive trajectory in high-quality earnings. Garmin turned 10,000 into 44,000. First Cash Financial, 10,000 into 86,000. Apollo Group, 10 grand into 78,000. Dell Computer, 10 grand into 1.3 million. Cisco Systems, 10 grand into 631,000. Paychex, 10,000 into 257,000. Quality Systems, 10,000 into 70,000. Hanson Natural, 10,000 into 2.6 million. Chico's FAS, 10,000 into 73,000. Monster Beverage, 10,000 into 61,000. The Monster is interesting because this is the best performing stock of the last 20 years. A hypothetical $10,000 investment grew to $10 million. We're going to turn this presentation into a book, and I'll have much more to say about Monster in the book. So if your thesis is growth, if you're a growth investor, I want you to focus on companies that are in the upper right box and that are moving in an upper right direction every year, forging what I call an earnings power staircase. These are the companies that have profitable growth. And the next step is, in our checklist here, is competitive advantage. If a company is forging a staircase, it probably has a competitive advantage. There are 5 types. If you saw Pat Dorsey's presentation here about a year ago, Pat is the expert on competitive advantage. When he was with Morningstar, he and his staff teased out 4 competitive advantages: low cost provider, high switching costs, intangibles like brands and patents and that sort of thing, and then network effect, the telephone, Facebook, that sort of thing. And then I add to that list ecosystem. So if you make a gadget and the gadget can talk to another gadget that's made by the same company, and then you can transfer all that data as you go, as new versions of that gadget come out. That to me is an ecosystem. With a network effect, the more people you have, the more valuable the network. But in theory, in an ecosystem, you really only need one customer. Warren Buffett describes a competitive advantage as a moat. And I bet that Larry and Sergey and Eric probably spend most of their time thinking about this issue. The castle is Alphabet, and the moat is whatever you guys and men and women can come up with that prevents the competition from taking your business. Warren Buffett says that if there are alligators in the moat, that's even better. We're not going to talk about competitive advantage, except to say that if you determine that a company has a competitive advantage, and it probably does if it's forging a staircase, then you want to think about the drivers that affect intrinsic value. Companies that have a competitive advantage, they're more valuable than companies that don't have a competitive advantage. If you sell a commodity, you really don't have any pricing power. People go buy your product from someone else if they can get a better deal. Intrinsic value is our third step. That's what the fair worth of the business is. Morningstar, they do a lot of great work with estimating a company's intrinsic value. They project that the business Alphabet's worth $755 a share. The stock price as of last week was $682, so the price to intrinsic value is 90%. If you buy Alphabet stock today, you're paying 90 cents for a dollar's worth of value. If you knew that for whatever reason the price to intrinsic value was going to go down to 75%, then you would wait, because then you get even more value for your money. Professor Aswath Damodaran spoke to your group, and if you want to learn more about valuation, check out his presentation, which is excellent. It's getting harder to estimate a company's intrinsic value because you have to figure out, make assumptions about how long the business is going to last. And as this research shows, in 5 years from today, 32% of U.S. public companies will be out of business. They'll be either acquired by other companies or they'll just go bankrupt. Versus 50 years ago, it was only 5%. So the rate of change is accelerating. And for better or for worse, Alphabet is one of the prime disruptors. One item I want to point out that is something to watch is that your incremental return on incremental capital is trending down. You're making bets that are outside of your core business. Hopefully those bets will pay off and then that trend will reverse. This will be something to watch. To learn more about intrinsic value, there's a great resource, Value in Securities, which I subscribe to and I highly recommend. And I mentioned earlier Old School Value, which I also subscribe to. They give you 10 years worth of financial statements, with just type in the symbol and the information's right there, and they have a lot of pre-programmed valuation models, so you don't have to build the thing from scratch and spend a couple of weeks doing that. All the information's right at your fingertips. Now, I mentioned that Ben Graham, yes?
Are you sharing the slides after this?
Yeah, he will be.
Yep. I mentioned that Ben was affected by the Depression, and so he took a hard money approach to buying stocks. So his method was what he called, this is after he figured out a new approach. He would buy companies that were selling at 2/3 their net working capital. So taking your balance sheet from December 31st, 2015, you run those, you gave 100% for your cash, he'd give you 75% for your receivables, you don't have any inventory. And then he'd subtract all your liabilities, and then he'd take your net working capital, he'd multiply that by 66% of that, and then that would leave $36 billion. He would pay $36 billion for the business. You got 745 million shares outstanding. So he'd pay $45, is that right? $48 for Google. All right, that's what he would buy it for. All right, now we're at step 4, position sizing. Position sizing is simply what percentage of your portfolio or your capital are you going to put into any single position. Now, it stands to reason that if you have an edge, then you should exploit it. And this is what Warren Buffett did after the famous salad oil scandal, the 1963, knocked shares of American Express down. Mr. Buffett determined that American Express's franchise was intact, and he put 40% of the partnership's funds into American Express, and it then went up 5-fold in 5 years. You really have to be honest with yourself, though, in terms of whether or not you have an edge. There are 4 types: information, analytic, behavioral, and structural. You also want to ask yourself, what's the consequence if I am wrong, and can I afford that consequence? My advice is, if you don't have an edge, you start small, especially with these growth companies, because we've seen how poor the subsequent investment returns are. And then build your position over time as you get to know the company better. You may get a better entry point in terms of price to intrinsic value. And absolutely, positively have a sell strategy, which is something we'll cover here in a moment. For men especially, you got to guard against overconfidence. And there are people that have gotten PhDs on this topic. I'm not going to talk about it at length. You can look into it if you want. But Kurt Schilling, we live in Boston. Kurt Schilling of the famous Bloody Sock, retired. He was into games. He started a business, 38 Studios. He put his entire $50 million net worth into the business, and then the business went bankrupt. Other examples of overconfidence include the Hunt brothers with silver in the 1970s, and then long-term capital management. I had my own overconfidence story. I invested in China Media Express in 2011. It seemingly passed the 3 checklist items that we've just discussed: high quality earnings, competitive advantage, and it was cheap. Selling at 8 times earnings, had $200 million of cash, no debt, audited financials by Deloitte, Hank Greenberg, who had built AIG into one of the preeminent insurance companies, he had put $80 million into China Media Express, and one of his colleagues was on the board. But alas, China Media Express was a fraud. There was no $200 million. So after the grieving process was over, I determined that I was going to turn lemons into lemonade. And I did a post-mortem, or in this case, an autopsy of what I did wrong, and identified 3 errors, 2 of which we're going to get to shortly. And I realized that I never wanted to be in a position where I was down 25% on a portfolio. So this leads to position size. There's a study by Dr. Van Thorp of people that they all get a hypothetical $100,000. They all get the same trades, same number of winning stocks, same number of losing stocks, both in terms of quantity, frequency, and magnitude. And yet, 50 simulated trades later, the ending balance of capital ranges from complete wipeout to $13 million. And Dr. Thorpe says the reason for this is position sizing and psychology. So if you want to learn more about position sizing, I recommend this book. This brings us to step 5, sell. What's your exit strategy? Before China Media Express, my exit strategy was qualitative. Position size gets too big. Maybe I thought that the intrinsic value of the company was declining. Maybe I thought I had a better idea elsewhere. Since China Media Express, I realized that I've got behavioral limits, and so I wanted to introduce some objective criteria. So I never turned a small loss into a big loss. And so I'm going to go through these items right now. The first thing I want to mention is that selling is hard. You probably heard this famous quotation by Vince Lombardi. Just put it in human terms. When you're a kid and your mother was reading to you when you were in your bed, did your mom ever read to you stories about great losers? Or when you go into the park, do you ever see a statue of a great loser? No. We weren't wired to be great losers, and yet as investors, that costs us money. So what I devised are these safety switches. And a safety switch is simply, it's a button that if you see the machinery breaking down, you just hit that button and the machinery turns off. And this way you stop the problem before it gets even worse. So I'm going to go over 4 safety switches. The first is a simple one. If before you buy a company, you determine what's the maximum percentage decline that you're willing to let that stock go down. Maybe it's 20%. So if the stock then goes down 21%, then you sell. No ands, ifs, or buts. I can't tell you what the correct percentage decline is because that's like me telling you who you should date. But William O'Neill of Investors Business Daily, who's an outstanding investor, he's also written several books. His rule of thumb is if a position declines 7 to 8% from its purchase price, he sells. If that's too rigorous, too quick on the trigger for you, maybe you do something where you sell 50% of your position if it goes down 10% and the other 50% if the price decline is 25%. But you got to have this in writing before you buy the stock, because once you own that stock, you get all these emotional biases kicking in. There's a study about coffee mugs. A Nobel Prize was won by Daniel Kahneman over the notion that we'll pay $3 for a coffee mug, but we won't sell it unless you offer us about $7. That just doesn't make any sense rationally. But it gives you an idea of some of these challenges that we have at selling. I want to point out that sometimes you may not be able to get a bid if you're trying to sell. You may say, all right, I'm going to sell at 7 to 8%, or I'm going to sell 50% if I'm down 10%. In this LinkedIn, in one day last week, it fell 35%. You're not going to be able to get in until you get that 35% lower number. So this is why position sizing is important. You got to get that position size correct even before you own the stock. Now, Warren Buffett has said his favorite holding period is forever, and that is true if you buy and hold the right company. If you buy and hold a Microsoft or some of these other companies. But if you buy and hold the wrong company, then you could get wiped out. I want to show you a chart of a couple of companies. Uranium Resources. This company would have turned a hypothetical $10,000 into $17. That's a 99.84% decline. And Arch Coal. This would have turned a hypothetical $10,000 into $2.81. If you don't have a safety switch, you could ride one of these things to zero. And you get into this point where I'm down 25%, you may even double down. That is, you can blow up your portfolio quickly. The second safety switch is what I call the 1% rule. So let's say you have a hypothetical $100,000 portfolio, and you say, I'm willing to lose a maximum of $1,000 on any position. And so you can come up with different scenarios depending upon how much you think you might lose on a percentage basis before that stock then goes up to its intrinsic value. And the idea here is these are 4 scenarios. A utility has historically been a low volatility stock, and then the highest volatility stocks would be companies that are pre-revenue. So you can use this approach to think about what your position sizing should be. And the great thing about this approach is if you use the 1% rule, you can have 10 successive losers and you still have 90% of your capital. So that's a disciplined, repeatable, and explainable process that will protect you. Third safety switch is what I call reward to risk. So let's say that the stock's $50 and you think it's worth $65. So your upside, your expected profit is $15. Now the smart money says have a reward to risk ratio of at least 3. That's investing probabilistically. That means you're going to bet $1 to make $3. You don't want to bet $1 to make $2 or bet $1 to make $1. That doesn't make sense. So if then you buy the stock and it goes up to $65, you've made 3 times your bet. So congratulations. Let's say you hang on and it keeps going up to $75. Now you've made 5 times your bet. That's even better. However, let's say the stock goes down to 45. Well, you bet $5, you've lost $5, so now you're minus 1. My recommendation is this is where you sell. If you're going to have a stock that's losing money, you never want to lose more than your bet. So this is the demarcation. If, however, you're too stubborn and you're not able to sell and the stock goes down $10, now you're down 2. And then if you're hanging on and it goes down to $25, now you're at minus 5. So like I said, if you're going to invest in if you have a stock that's going down, sell it at minus 1. Our fourth safety switch, price moving average. Now this is an idea from Paul Tudor Jones, billionaire hedge fund manager, and the founder of the Robin Hood Foundation, which is created to help children at risk. And he has managed money since the late 80s. And I think his record is, I think every year he's made money. My metric for everything I look at is the 200-day moving average of closing prices. I have seen too many things go to zero, stocks and commodities. This quotation is from Tony Robbins' book, Money, the Master of the Game, which just came out, which is fantastic. So we're going to start looking at some companies using this 200-day moving average. Now, you don't even have to use the earnings power chart or some of the other methods. You can just go to stockcharts.com. I think it's $15 a month for a subscription. We'll start with the bond market. This is the corporate bond market. So if you're buying a company's debt, you can see that an index of corporate debt, the red black line, the closing price, that's daily closing prices, and that is 2268. This is a Vanguard index fund. And then the average of the last 200 days of closing prices is 2250, 2260. So on this basis, Paul Tudor Jones, I don't want to put words in his mouth, but my interpretation is he would be bullish on corporate bonds. In contrast, we'll look at stocks. This is Vanguard's total stock market index fund. The 200-day moving average is 50.6, and then Friday's close was 45.92. So this means we're in bear territory. You never know how, just as you never know how high a stock's going to go or an index, you never know how low an index is going to go to. This is important background information because if you're thinking of buying a company's stock, 75% of stocks are going to go in the same direction as the overall market. So if you're thinking about position sizing, maybe you hold back that position sizing somewhat because we are in bear market territory right now using this approach. Here's Microsoft's 200 stock price versus 200-day moving average during the 1990s. You can see that for most of the time, most of the time the blue line, the moving average, was like a support level. There were a couple of times when the price went below the 200-day moving average, but by and large, the closing price was always above the 200-day moving average. So this is a, by and large, this is a bullish trend. In the 2000s, you probably know that Microsoft got disoriented. We can see that there was a 50% decline in 2000. This is a 50% decline after Microsoft went under its 200-day moving average. So if this approach to investing appeals to you, this you would have gotten out before that 50% decline if you apply these methods rigorously. And then in 2008, when we had the global credit crisis, there again, Microsoft stock went down 50% after the closing price went below the 200-day moving average. So you had time to get out if you were paying attention. You're probably asking, what about Alphabet? Well, you're 6% above the 200-day moving average, so this is a positive sign if you're using this approach. Interactive Brokers is a stock that I owned, but I sold it after I noticed that it went below its 200-day moving average, and you can see that it then fell 24%. Before China Media Express, I would not have sold, and then I would be in this quandary, well, what do I do? I never want to be in that quandary again. Deutsche Bank is down 45% since it fell below its 200-day moving average. And this is an important bank to watch because as Deutsche Bank goes, I think Europe will go too. They've got $70 trillion of derivatives, and if you own the bank, this would have been a sell signal. You're probably aware that oil prices have gone down. Oil is now 70% below its 200-day moving average. So if you had sold in August of 2014 at about 100, congratulations. The last price is about 31. So you don't know how low these prices are going to go, but you just know that either you reduce your position size, maybe you introduce a hedge element, or take other action that protects your wealth. Horsehead Holding is down 99.48% in less than 1 year. Look how violently some of these companies can collapse. Lynn Energy, down 99% since it went below its 200-day moving average. Now, probably some of you are math majors, so check this out. After Lynn went below its 200-day moving average, it fell 50% to $14. And you may think, that fell 50%, now it's cheap. Well, then it fell another 50% to $7. Now it's really cheap. And then it fell to $3.50, and now you're thinking, where's the truck? I'm going to back up the truck. And then it fell another 50% to $1.75. And then it fell another 70% to 37 cents. The more you lose, the harder it is to recover. You're down 10%, you only need 11% to get back up. You're down 25%, you need 33%. Down 50%, now you need 100%. So that's a one bagger. Now check out how asymmetric the math gets here. If you're down 75%, you need a 300% return. That's a three bagger. Down 90%, you need a 900% return. Down 99%, 9,900%. Now in my case, I was down 100%. So I get this number sign division number, and that just means, you know, really bad. So the key point I want to give you is, if the ship is sinking, you got to get off. And if you have trouble selling, there's this great book that just came out called The Art of Execution by Lee Freeman Shore. Came out last fall. I read it in one night. It's terrific. There are 5 personality approaches he identifies. Read the book and see what personality type you are, and maybe you can improve your decision making. All right. Here at the Googleplex, you have at least 30 cafes, including Cafe Badal. So this is the sign that we're about to wrap things up. So what I suggest is that you do a self-assessment of what investment grade you are. If you focus on the stock price, then you are a beginner. If you focus on earnings quality, which I hope you do, you use the earnings power chart, then you're an intermediate investor. If you're focusing on valuation, price to intrinsic value, value drivers, competitive advantage, then you're an advanced investor. And if you're focusing things on like position sizing, reward to risk, exit strategies, then you're an expert investor. So there are 2 actions that I recommend. You can do these today, do these tonight. The first is define your strategy. It should have 3 parts. What kind of companies are you looking to buy? What things are you going to think about while you own that business? In other words, how are you going to keep up to date with the news? And then what are the exit strategies for you to sell? Put this in writing, because if you don't put it in writing, then you really don't have an exit strategy, or you don't have an investment strategy. The second thing I want you to do is create an investment journal. So open up Google Docs, Excel, and every time you buy a stock, I want you to put in the company's name, the symbol, the number of shares you're buying, the purchase price. I want you to put in your estimate of intrinsic value, and then I want you to put in, you can have a formula that tells you the reward to risk ratio. Should be at least, what, 3? Okay. Paul Tudor Jones, do you know what he looks for? 5. So if you want to be a billionaire, look for 5s. And then when it comes to time to sell your position, make a couple of other data entries. The sell price, the date, what your thesis is. Maybe the company broke the 200-day moving average. Maybe the thesis is not as attractive as whatever the reason is. Just make note of that information. Then you can compare your actual reward to risk ratio to your expected reward ratio. And if you notice that there's too many negative, minus 1.5, minus 1.2, minus 1, minus 2, minus 3s, then you need to rethink your approach. So if I had to sum up everything, the one thing that I want you to remember, you want to forget everything else that I said, is do not turn a small loss into a big loss. And with that, I want to thank you very much. It's been exciting to come here and think about what I was going to say to you. My father-in-law, Carl Peterson, is an engineer. He was a professor at MIT of mechanical engineering. Probably most of you were electrical engineers. And this is my first presentation to a non-finance group. So if you have any questions, I'm happy to take them. And if not, thanks again.
Thank you.
Well, I had 2 questions actually. This is all very interesting. So one question is if both valuing approaches are so good, why don't combine them? Have you tried looking at them together, subtracting all of them? That would increase the gap to GAAP,
Yep.
but maybe that's a good thing. And then a second question is here.
Let me take that first. And let me throw the question back at you. Why don't you think we want one alternate income statement? Well, let's start with investment. Well, let's start with investment in fixed capital. And I always think about this like you got a commercial banker and a venture capitalist sitting across the desk from each other. And they're arguing each of these 4 structural limitations that the GAAP income statement has. The commercial banker is going to say, look, there are studies that say the more capital intensive the business, the more likely it is that that company is going to go bankrupt. Now, I excluded them from this presentation in the interest of time, but the studies are out there. So the reason that the defensive investor wants to look at capital spending is because, especially if you know the business, you may want to say, okay, why is Alphabet's, what are they spending their money on? Is it to maintain, so you get 100% of your profits from search, right? From what I read, almost 100%. So I want to know, if I'm an analyst, how much of that CapEx is going to search? And then how much is it going to your bets, right? I know that you know search, but I may not have the same degree of confidence that you know medicine or space or some of these other initiatives that you're working on. So I may want to take a more conservative approach when I'm tracking your sources and uses of cash. Now, the venture capitalist, he's going to say, they've got a great track record. I've worked with them for 10 years. The owners own a large slug of the business. I have total confidence in how those investments are going to work out. When you're working with companies that are not of this your caliber, this is a very important item to look at. If you're dealing with a retailer, for example, and they make sweaters, and you notice that their inventory is piling up at Christmas, well, you know they're going to have a bad quarter, because if they can't sell at Christmas, they're not going to be selling the first quarter. You know, Christmas is the selling season. So it's a way of diving into a company's financial statements with maybe a more informed view of the business. I'll give you one more. Stockholders' equity. A company is not obligated to pay its stockholders any fixed rate of return. When you buy a company's stock, you don't sign a contract with the business. However, when that company borrows money from a bank, there is a contract saying that the borrower is going to pay, LIBOR plus 100 basis points, and the lender is going to put a lien on the assets. That doesn't happen in the enterprising mindset. So there are 2 different mindsets here. And what I want to do is I want to, almost like hearing in stereo, that's just better music than mono. You had another question, or should? Okay, we'll come back.
Thank you for the talk.
Thank you.
I had a question about the last part on selling.
Yes.
In one of the older letters, Buffett gave an example of Washington Post, of how if Washington Post was worth 400 million, and if it went down 50%, he would basically just buy more rather than sell the stock, because the intrinsic value of the business has not changed. So obviously the difference is, in his case, he has an analytical edge, and he understands the business, and he knows that Washington Post is truly worth 400 million, and he would not sell. In our case, I'm assuming what you're saying is we'll have these kind of objective rules, because maybe our analytical edge or understanding of the business is not as strong as Buffett's. So my question is, why even bother with picking stocks if our analytical edge is not enough to protect us from the volatility? Why not just do indexing and not bother? Is there any reason? So to me, it seems like it's mutually exclusive. Either I understand the business and I should be stock picking, or I don't understand the business and I should just be indexing. Why do this half kind of a thing where I don't quite understand the business, I have these rules, and yet be stock picking?
Well, to your point about Mr. Buffett, the Washington Post I think he said he believed that the business was worth about 400 million, and he was buying when it was $80 million, right? Now remember, he had an edge because he owned Buffalo News, so he knew the business. Plus, I believe he got a board seat. So not only did he have information advantage and behavioral advantage and analytic advantage, but he could help influence management's capital allocation. Most of us don't have that opportunity. So to the question about index funds, that's what Mr. Bogle would say. He would say that you should use low-cost index funds. But as he told me in a conversation we had once, he said, most of us have a little bit of a gambling instinct, or there's a company that we like. If we use their, let's say, their search function 25 times a day for 15 years, we might think that that business is going to be around for a while, and we want to participate in its success. But by the same token, I'm not going to pretend that I know the business intimately. So it's a you want to just have some protection in case you misjudge the business. Now, those numbers that I gave you, the 1% rule, for example, that may not work for you. Maybe you want to use 2% or 3%, whatever it is. That's something that you got to figure out for yourself. You may only want to buy a couple of companies. Most companies do not make it to the upper right box in the earnings power chart, and very few forge that earnings power staircase.
I guess just a clarifying question, if you may. I guess my point is, if we are not in the same position as Buffett, where we do have an analytical edge, why even bother is my point. Is if I'm anyways going to, I mean, we are getting the benefit of owning Alphabet by Alphabet is part of the index, and if it's going to do well, it's going to be a bigger part of the index. So why bother anyway?
Well, I find this business to be the most interesting business there is. There's something new every day. You're thinking about not only things in a quantitative sense in terms of like earnings quality, but qualitative too. Competitive advantage, landscape analysis, Porter's 5 forces. To me, it's a intellectual challenge. And so I enjoy the process. If someone doesn't enjoy this type of work, they should have their money professionally managed. So if you have a business that you drive by every day or that you deal with, you like listening to, there's a newspaper that you like, whatever. You have some sort of intimate personal relationship with the business and you think you want to be an owner. I'm trying to give you a strategy to help tilt the odds of success in your favor.
Thanks for doing the talk.
Thank you.
So my question is, it's going to look like it's along the same lines, but it's with a different focus. Buffett, when he was asked about Berkshire and the price moving up and down, I think in 2012 or 13, he said, there are times where price to book varies from like 1.2 to like 4. And he says, I quote him here, unless you can watch your stock holdings decline by 50% without becoming panic-stricken, you should not be in the stock market. So it looks like it's the same, but my question is actually different. Given the volatility of stocks, right, does anything like a 10% or a 1% or 20% rule, does it make sense? Like, are you giving up the opportunity of being fearful when others are greedy and being greedy when others are fearful?
Let's go back to the 1%. Here are 4 scenarios. If you expect, let's focus on the micro-cap company. In this scenario, you're thinking, I can handle a 35% decline, but then I think that it's going to go up tenfold because all your friends are drinking the product, using the product. It's got a secular tailwind. So you just figure out what's the most volatility that I can live with And then if you can think about it in those terms, then you can figure out your position size. And so, yeah, then the position goes down 30%, no big deal, because you still are following your strategy. Or if you think you want to handle a 75% decline, which sometimes happens, then you got your position sizing here so that you're covered. The point is that you need a strategy in place before you buy the stock. Now, you mentioned Berkshire Hathaway. Berkshire's lost 50% of its market value 4 times over since it went public. So even the bluest of blue chips can suffer those kinds of declines. And the other thing I want to point out is, let's say you underestimate how far a company falls, and you follow your strategy and you sell your position. You don't have to, that doesn't mean that you can't buy that position back. What you could do is you say, okay, I'll buy it back in, say I'll buy back 25% of my position after the next 10Q or the next 10K is filed. And if there's a smoking gun, if it's a company-specific reason, fraud, something else, some reason that you don't know about, but maybe lead steer investors do, and that's why the price is declining, but you wait until the next SEC filing comes out, and then you buy back your position, starting, say, 25% a quarter for 4 quarters, then you're back to your original position. So you can have these workarounds and these apps to help you get back into a position if you think you're selling Microsoft in 1991 or Berkshire Hathaway in 1975.
Next, we have time for one final question.
I think my question is also in a little similar line. Maybe I want a clarification. You say you want to sell when it drops below a certain percentage. Nowadays, market even fluctuates so much, right? Based on given news and something. A lot of people, even pundits, have said that certain good stocks, if you have it, example, Microsoft or Amazon, something, they could fluctuate 10% in a given week, but you could be missing out on 10 baggers or 100 baggers if you act on those volatility, right? So when you say you drop, you sell on certain percentage down, are you discounting the volatility, or if your fund or if your stock is 10% below the market, we just, let's say S&P today is opened up 5% and my stock went 10%. So am I only down 5%, or am I really down 10% in your view, right? I want to understand that.
That's a great question. I didn't address it. That's something for you to answer. Do you want to sell your positions if they're falling at the same rate of decline as the overall market? Or are you looking for, say, some decline that's above and beyond what the market decline is? And I don't know the answer to that for you, because these are personal decisions that you have to make. What I'm trying to say is, in my case, I recognize one of my limitations is that getting emotional about a position that's down 25%, and I don't want to be in that position again. And so I've created some strategies so that that's not going to occur. And so you may decide that you'll put up with the market volatility, you're just going to focus on the company-specific volatility. And that may be an excellent approach.
Thank you so much for an engaging talk and provocative conversations. Thanks.